Hi, my name's Greg Carroll from More Than Accountants, and I'd like to show you today how you can use investment property to actually pay off your home loan. This is actually a strategy that many of our clients are using right now to great effect, and we'll have a look into that a little bit later. But I guess the first question is this going to be relevant to you? This is a strategy that's specifically designed for people earning $100,000 or more who want to start an investment portfolio in the next 60 days, but also want to be able to pay off their home loan in the next 5 to 6 years. So what I'm going to step you through is a couple of things. We're going to look at a core problem that's experienced by most first-time investors in terms of getting that investment plan starting, why the traditional investment model is broken, how to secure an investment property that pays you and pays your home. I'm going to show you some real-world examples that clients that we have are achieving right now, and this is related to properties in the Brisbane market. I'm going to show you step by step the process we're using to help clients get those results, and I'm also going to show you how you can use that process to get started today. But before we jump into that, I just want to give you a brief overview on who we are, just so you know a little bit about our business. So our company is More Than Accountants, and we're actually an accounting practice that specialise in assisting property investors. So we currently provide tax advice to over 2,000 property investors every year, and we have also directly assisted hundreds of clients to build investment portfolios by providing strategy, research and advice through our property advisory arm. So what's the biggest problem I witness with first-time investors? It's something that I call breaking out of the procrastination cycle. And there's a reason why this is important, and it's all to do with this guy, which is the elephant in the room. When I'm talking about the elephant, what I'm talking about is there's a problem that many Australians are facing. They may or may not be aware of, but what I see quite often is a lot of people are sticking their head in the sand about this issue. And that is that superannuation is not going to be enough to provide for a comfortable retirement. In fact, when you do the numbers on most people, when we sort of have a look at what they've got in superannuation when they want to retire, generally that's going to provide around about 30 to 50% of what they actually need to live a comfortable retirement. And if we look at a typical scenario, so someone who has about 300,000 in super, they've got around about 20 years to retirement, and they have a desired income in retirement of 50,000. So by retirement, if they get a pretty reasonable return on their super over the next 20 years, they're probably looking at ending up with a lump sum of around about 830,000. So what's that going to deliver them? If they invest that and get what I would say would be a reasonable average return of around about 4.5%, they're probably looking at around about $37,000 a year in income, which probably doesn't sound too bad. You're going, okay, that's not too far off that 50. The issue, however, is that's $37,000 in 20 years' time. So that's not what $37,000 is going to be worth in terms of purchasing power, because obviously what we also have to account for is the impact of inflation. So once we bring that back to today's dollars, we're talking something closer to 20,000. So there's still about another 30,000 in income that needs to be made up. Realistically, that person in the next 20 years, what they actually need in terms of an asset base, and I'm talking investable asset base, is more like around about $2 million. So there's around about a $1.17 million shortfall. If you do look at the numbers, and actually if you look at some of the averages in terms of super balances at the moment, there's a lot of Australians who are probably in their sort of mid 40s to early 50s that are sitting somewhere in that ballpark at the moment. Which brings us to the procrastination cycle. So obviously there's a problem there, and look, at some point for many people, they realise that they've got a problem, they realise they've got a shortfall, and they get to a point where they're going, okay, we need to do something about this. And so for a lot of Australians, they look at different things. A lot of people say, okay, let's go buy an investment property, get that started. So what they do is they start researching. They start looking around, going on the internet. They might go to seminars. They might talk to friends and family or work colleagues. They might actually go and get some advice, talk to a financial planner. They'll do a whole range of things to start gathering information. But part of the issue with that is they end up talking to so many people, going to so many sources, that they hit a point where they get basically an information overload. There's so many different, I guess, philosophies, approaches on investment, ways to go about things. Not suggesting that any of them are right or wrong, but there's just a whole range of methods, and it becomes very hard for people to work out what to do. So ultimately they get a bit stuck at that point because they're presented with so many different options, so many different directions. They're obviously fearful of getting that wrong. It all starts to get a bit hard, and then they end up sort of backing away from it. So they put it on the back burner for a while and say, let's put it off. And of course what happens is another 12 months goes by or another couple of years go by. They're no further progressed. The problem hasn't gone away, and they get back to that point again of, we need to do something. The issue, however, if we're talking about procrastination, is there is actually a cost to it. And look, I understand why people procrastinate, because there's probably a bit of fear of getting things wrong, not knowing what to do. But at the end of the day, if you had to build another 1.17 into your wealth, the question is, would you sooner have 20 years to be able to do that, or would you sooner have 5? So if we've got a 20-year time frame and we need to reach our target over 20 years, that means we need to generate $58,000 a year in investable assets. So that's still a pretty reasonably big number. It's not insurmountable, but it's not insignificant. But the bottom line is we've actually got 20 years to build towards that. If we just let even 5 years pass by, that number starts to creep up to 78,000. So before we were at about 58, now we're at 78. So suddenly we've got to find another $20,000 a year to be able to do that. Let another 5 years go by, so we're at 10 years. Now we're up to about $117,000 a year we've got to hit. And if we leave it till 5 years to go till we're retiring, then we've got to get $234,000 a year, which obviously starts to become pretty near impossible. Or to do that, what you're doing is putting yourself in a situation where you're going to have to take some fairly high risk strategies to be able to do that. And if you're 5 years from retirement, going high risk is not preferable. But this is a situation that's not unusual. So if you're in that situation yourself, you're not alone. This is what I see with most clients when I first meet with them. They've usually been thinking about this for some time. They've probably done a lot of those things, gone through that procrastination cycle, found themselves pretty confused, not knowing where to start, and in many cases are really frustrated because they want to be able to move forward. They want to be able to do something. They want to be able to get into the investment market, get an investment property going, but they just don't know where to start. So if you're feeling that way, you're not alone. But there's actually a reason. At least a reason that I see why that's happening and why people get stuck. And it might sound a little bit odd, but from my experience, what I'm seeing is that people are focusing on the property rather than focusing on themselves. And I know that sounds a bit weird because we're talking about property investment and you're going, well, surely the property is important. And it is important. But before you look at investment property, what you need to do is start identifying what is it that you actually need to do. You've got to start having a clear understanding of what you need to achieve. And what I mean by that is for those clients where they'd been stuck, what they hadn't done is they hadn't actually clearly established what they needed to achieve financially and by when. They hadn't actually put any numbers around it. They were kind of just going, hey, look, I got to do something, just trying to go out there looking at property, but not actually clear on what it was they actually need to do. The start point really needs to be putting some clear goals around time frames, what needs to be achieved, actually how much in dollar terms you actually need to hit. Like, what are those things as a start point? The second thing is to actually determine clearly what your scope and capacity is to achieve it. So it's one thing to have a goal and a target, but then you also need to go, okay, can I actually do this? Do I have the capacity to do it? Is there scope to do it? Because it's one thing to have a goal, but if you don't have the means or ability to do it, then obviously that goal is unrealistic, unattainable, and you're not going to get there. So you've got to actually determine, okay, what can I do as well? And then if those two things join up, then obviously the next step is to map out a clear path of how you're going to get there. So I know that sounds really obvious, but to be honest, from what I see in most people is they don't do that step first. What they do is they jump straight ahead just start going looking at property, but they actually haven't done this critical step of actually defining what is it they need to do and what do they need the property to do. So we've got to get clear around that stuff first. It's a quote you probably heard before, but if you aim at nothing, you'll hit it every time. And that's kind of it. If you're going out aimlessly, then how do you know that what you're doing or the property that you're looking at or the property you're thinking about buying is actually going to deliver what you expect? So what I found was once with clients, once we could actually turn that around a bit and actually get a clear strategy that looked at both what their shorter term goals and their longer term goals, suddenly that sort of freed them up. Suddenly they went, okay, now I can understand what we need to do. Now I've got a clearer picture. And for many clients who have a home loan, they were struggling with that concept of, okay, how do I get into the investment market and pay off my home loan? Or weren't sort of seeing that those two things were connected. Once they could see that actually, no, you could actually join the dots and that buying an investment property and paying off the home loan were both goals and both needed to be part of the plan, that started to free them up. So what they could do then was break out of that procrastination loop and actually go from that and start to move into action. So in terms of being able to help clients to move forward and achieve their goals, part of that essential step was to get clients to actually shift the way they thought about property investment. And that's shifting away from what I would say is the traditional investment model, which looks a bit like this. So typically with a property investment, the objective is to pursue growth, obviously, like we want to grow wealth over time. And in terms of doing that, we buy a property, tends to get negatively geared, which tends to generate a cash flow shortfall, so that could be $100 a week, let's say. And so you're putting $100 a week into that property. You're making a loss there in terms of cash flow, but the objective is that over time you'll be rewarded with capital growth. So you're losing money out of your pocket every day, but the property is going to grow in value over time. So that's the traditional model. The issue with that is the one thing that you can't ever guarantee, irrespective of how much research you do and whatever the numbers are going to look like on a property, you can't guarantee what that growth is going to be because there's so many external factors that could actually influence that in terms of political decisions, the economy, what happens globally, etc., change in lending rules like we're facing at the moment. There's so many factors out there that can influence growth, irrespective of whether a property looks like a good opportunity or not. So the issue then becomes if you're not achieving the growth outcome that you want, but you're still paying money into that property, then that starts to become a lot harder. And if that growth actually diminishes quite substantially, flatlines, or even if that property goes backwards and you're still putting money into that property each week or each month, then that starts to get into an unsustainable situation because the question becomes how long are you going to continue to do that while you're not being compensated by growth at the other end. And this is where a lot of people come unstuck with property. So that model all works well when the market's going up and it's growing, but as we know, over the long time, will property grow in value? Yeah, sure. In most markets, it does it. But in the short to medium term, you can have all sorts of fluctuations and different cycles. And so if you're pumping money in, you've got to be able to ride out those cycles all the time. And that's where it becomes very hard for people to hold property long term. And if you can't hold property long term, then how do you get rewarded with that growth? So the way we try and approach it with clients, particularly under this model that I'm talking about, is that what we look for is properties that actually have a cash surplus from day one. So in other words, rather than them taking money out of your pocket, they're actually putting money into your pocket. So if you have a property that's paying for itself, even if the growth falls away a bit or it flatlines for a period, it's not going to be as stressful for you to hold that property because it's covering its costs. Or even, as we said, even if it's paying money into you, then you've got that ability to hold that long term, irrespective of what the market fluctuations are doing. So it makes it much more sustainable. But here's the other thing. Whereas under what I'll call the traditional model, your total return at the end of the day is going to be made up of the amount of growth you get less the amount of money that you put into that property, so your cash flow shortfall. So the net of those two figures is going to be your total return. But if you've got a property that's actually paying you money, that's got a cash surplus, then your total return is going to be a combination of whatever growth you achieve on that property plus the cash that's coming in. So it's those two factors combined. So even if you only get modest growth on that property, either way you are still going to be coming out ahead because that's your combined return. So that's the start point for a lot of clients who are in that position. Just being able to get them to see that there's a different way to approach this could suddenly sort of free them up. So they weren't seeing it as a choice of, well, either I have to pay off the home loan or I can invest. They could actually have the ability to do both. So I guess that's all fine in theory, but the question is then, okay, so how do we go about it? Where do we find these properties? What's the approach we're going to use? And that's what I'm going to get into now. So I'm going to take a bit of a sidetrack here. The way we approach that, or the way to understand how to approach that, is you need to understand the concept of marginal gains. And so there's some of you may be familiar, there's a cycling event called the Tour de France. And no, I'm not going to recommend that you go buy a chalet in France or anything like that. But there's a team that's actually dominated in the Tour for the last 7 years, which is called Team Sky. And they've actually won 6 out of the last 7 Tour de France's. And part of the reason they've been able to achieve that is they use an approach called marginal gains. And what marginal gains is, or the thinking around marginal gains, is that it's not actually looking for a silver bullet or one big answer to a problem. It's actually looking at a lot of little things, making small changes, small tweaks, small steps in improvement. But all those incremental steps actually add up to a bigger picture and a bigger outcome. And so when it comes to finding investment property that ends up paying you rather than you paying it, the approach we use is that marginal gain approach. And what that means is, looking at an extensive range of factors, looking for all the small marginal outcomes, the little tweaks that we can make, and the small steps that all add up to a bigger outcome. So I'm not going to go through all these today in detail, but I put it up here on the screen for you to have a look at. This is by no means a complete list, but it does cover off a lot of the factors that you need to weigh up. So the issue is, when most people think about property investment, they may be, particularly when they're looking at potentially even cash flow, they might focus on one or two aspects. What you really need to do is drill down and look at all these individual items and start to see how they all add up and come together. And the reality is, what's going to happen is that different properties are going to work for different people, and something that might be cash positive for you may not be for someone else, vice versa. It comes down to what's your ability to be able to do that. There's a whole range of factors that are going to add into it, but it's understanding all these different components and how they come together. Okay, so hopefully that makes sense. So look, what I'd like to share with you now is some examples. So this is actually real world examples. So these are properties that clients actually have gone ahead and purchased that are currently up and running, and show you some of the numbers on those properties. So first thing I want to say is, all these properties are in and around the Brisbane area. So we're not talking properties in remote regional locations or mining towns or any high risk areas. These are properties in well established areas that have infrastructure. They've got schools, shops, good employment, good growth numbers. So we're not talking about going out in the middle of nowhere in a high risk property. What I've also included with each of the property examples is to show what impact that cash flow, or the additional cash flow coming off that investment property and into a $400,000 home loan would have, in terms of the expected time frame that we would cut off that loan, and also the expected interest savings. So that'll give you a bit of a perspective on how a property can work and the impact that it can also have on a typical home loan. Okay, so for the first property, the yield on that property was 6.34%. The cash flow that we're able to generate off that for the client was actually $121 a week, so quite a strong cash flow there. That $121 a week into a $400,000 home loan would actually cut the term by approximately 10 years and would save about $107,000 in interest. The next example, this one had a positive cash flow of $63 a week with a 6.4% yield. The impact on a $400,000 home loan, that would actually cut 6.3 years off the term and save approximately $68,000 in interest. This next one, cash flow on that, $39 a week, which would cut around about 4.3 years and save around $46,000 in interest. This one, pretty good cash flow, $76 a week. That going into a $400,000 home loan would cut 7.3 years off the term and save $78,000 in interest. And the last one, so this one, not as strong as cash flow as some of those other examples I've shown you, so just into the positive territory with $23 a week. But even with that contribution, would still cut actually 2.7 years off a $400,000 home loan and save $29,000 in interest. So that's some examples of what some of our clients have been doing at the moment. But I guess the question for you is, okay, that's worked for them, will it work for me? Which is a fair question. So look, if you fit within this sort of ballpark, then I would say it's definitely something that could work for you and obviously is worth exploring further. So where do you need to be? Realistically, you need a household income of $100,000 or more. You need to have pretty good equity in your home. So I would say somewhere around about 30 to 40% equity in your home. So that might mean your loan accounts for around about 60% of your property value at the moment. So somewhere in that sort of range. Or you have available savings of somewhere in the range of $70,000 or more to put towards investment. So to put into your deposit and cost for investment. You certainly need to be up to date on all your financial commitments. You'd need a time frame of at least 10 years or more from retirement. It is generally not going to work for people who have a shorter time frame than that, unless you've got fairly strong servicing capacity. So I'd say like 10 years would be preferably a minimum, and you're currently not under financial stress. Obviously that's a critical thing. If you're sort of struggling where you are now, then taking on further investments really not going to work for you at this point, and you probably need to look more at other things like debt restructuring. Let's say maybe you've found your way here because you're in that point where you're in a bit of that procrastination cycle or that procrastination loop, and you want to get from a situation where you can start moving out of that holding pattern and moving into action. So I'd like to give you an opportunity to be able to do that today, and give you an opportunity to actually access our one-on-one investment service at a significant discount. So this is the service that clients on those examples that I've showed you, the exact service that they've used to go from a standing start to getting into their first investment property, getting that property up and running, getting it tenanted, getting that cash flow rolling in and start paying down their home loan. So for that service, we charge $2,200. That's our standard fee for that service. But for a limited number of applicants, I'm actually going to offer that at a discount. And we're going to reduce that price down to $1,100. So that's a 50% discount on that service. In addition to that, for clients who go ahead with us and they actually get their first property settled, I'm also going to include a depreciation report with that. So that'll basically be a full depreciation report from a quantity surveyor that's then going to assist with them writing down their taxable income and maximising their tax return. So those reports are valued at around $550, but we're going to actually cover the cost of that as well for any client who goes ahead. But I am going to make the point that this is a limited offer. So at this point, I'm actually limiting it to 4 people. Main reason being is what we do is fairly time intensive from our point of view in terms of the research and analysis that we need to do with clients. It's takes up a fair bit of time, and therefore obviously we can only work with a handful of clients at any one time. So I'm going to limit it to the first 4 people who take up this offer, and once those first 4 people are on board, then that's going to be it until we look at a further round. So in terms of that service, there's a number of steps that we go through. So just to give you a bit of a heads up on actually what would be involved if you did want to go ahead. So the first step is basically doing a comprehensive assessment of your financial position. So we'd actually do some projections on where you're heading at the moment, retirement-wise, and identify what sort of gap that you need to make up. So we'd actually crunch the numbers on, you look at your super, if you've got shares, maybe you even have some existing property, and we can basically map out and work out where you're on track for at the moment and what sort of shortfall that you're potentially looking at. We'll also actually do a review of your current finances and structure to identify areas where you can make improvements and savings that could actually help you pay off your home loan as well. So there might be things that, in addition to looking at further investment, just things that you might be able to do now in terms of your finances that could improve that situation. So we'll have a look at that as well. We'll work out what your scope and capacity is for further investment. So we'll actually look at what you can realistically do in terms of what's achievable, what's affordable, and then we'll develop an initial long-term investment strategy for discussion with you. So that's step number one. Step number two is then, after we've reviewed that information, is sitting down with you and having a one-on-one strategy session. So that'd be basically going through what we've already uncovered during our review, talking about where you're heading and going through that information in a lot more detail. And then also stepping you through some potential directions you could go in terms of investment and how to look at building a portfolio. So I'm actually mapping out a portfolio plan, talking about the steps that are involved in doing that. We'd also actually look at different directions you could do within that plan. So we'll actually look at different investment opportunities in terms of different approaches you could take. We'll look at how things with regard to taxation. We'll look at cash flow. We'll look at finance. So we'll actually, I guess, sort of share a fair bit of our knowledge with you, so that you get a good understanding of what the different approaches you can take are, what's involved in doing it, what the upsides are, what the downsides are. So you have a good understanding of what the risks are as well, which is pretty important. And hopefully at the end of that discussion, what we get to is a finalisation on an investment strategy. So at this point, we're not talking about specific properties, but we're just talking about concepts and approaches, which we can then work out, get a bit of a brief and direction that you're comfortable with, and then we can go forward and start looking at investment. So the next step is step 3. So this is the process of finding and analysing investment property options that fit with the investment plan, and then presenting those findings to you. So the objective of this phase is obviously to give you the research and analysis on those properties and give you as full a picture as possible before you proceed with any investment options. The next step is step 4, which is basically putting that plan into action. So once we've narrowed down a property that we want to proceed with, it's then about taking that property through and getting that property up and running. So it's coordinating contracts on that property, arranging the conveyancing, arranging the finance, getting the property settled, getting the property tenanted, arranging inspections on that property, and of course completing the depreciation report. So doing all the steps necessary to get that property up and running, tenanted and operating for you, so you can start actually getting some of that cash flow back in. So the final step, step 5, is the ongoing support and review of your plan to ensure you stay on track. So this would be looking at things like tracking your debt reduction, regularly reviewing your finances to make sure that the structure you've got is appropriate and also to make sure it's competitive, looking at the actual investment performance, how's that tracking, and also identifying when you're in a position to take that next step and progress to the next phase in your plan. So if you sign up for our investment service, those are the steps that we would work through with you to get that first property up and running, and obviously, as I said, step 5, to give you that ongoing support to work to that longer term plan. So in addition to the discounted fee that I'm offering at the moment to a limited number of applicants for our one-on-one service, there's also a couple of other things that I'd like to make you aware of. The first one is that if you provide all your information for the financial analysis, and we identify that you are not financially in a position to invest at this point, we'll actually provide you with a full refund. No questions asked, guaranteed. But if you do have that ability to go ahead and we go through, do the analysis, then sit down with you in step 2, go through all that information, map out a strategy, and at the end of that meeting, you don't want to proceed any further at that point. So we've talked about the steps you could take, what you could do from there, and if you don't want to proceed at that point, we'll actually give you a 50% refund of your fee. So just recapping, if you want to proceed with the service and you'd like to apply, so the fee is being discounted down from $2,200 to $1,100. If you proceed through and you with the property on your first property, we'll actually cover the cost of the depreciation report on that, which is $550. If you provide all your information at the first stage where we do the analysis and we identify at that stage that you are not in a position to proceed, we'll actually give you a full refund of your $1,100 that you've invested. If we progress through to stage 2 or step 2, which is the strategy session, and we get to the end of that session and you decide at that point that you don't want to progress any further, then we'll give you a 50% refund. So I'm really trying to make this as low risk as possible for you, because I understand for most people this is a big step, but I think in terms of what I've outlined there, it will give you an opportunity to get your plan started. It'll give you a good opportunity to get a good feel for who we are, for fairly low risk. And at the end of the day, if what we're proposing isn't going to fit with your direction, then worst case scenario, you'd be out of pocket for $550. So look, if you want to progress with that offer, you'll see there's a link you can click on below. That'll take you through to a registration page where you can basically fill out your information. That'll actually email you all the forms and information that you need, plus the invoice for our fee. Once that invoice is paid and that information is returned to us, we'll review that information. Generally, there's about a week to do a review on that, and then we'll make contact with you to arrange a time so we can actually do a face-to-face session. If you've got any questions or would like to get some further information on the service, and there's something that I haven't sort of covered off today, that's fine. So if you go through and register, that'll actually also send you my contact details, so you can shoot me back an email and I'll do my best to answer those. Thanks very much for your time today. I hope you've found this information of some value. Would certainly welcome the opportunity to be able to work with you.